stop what you're doing. If you own ePlus, or frankly, if you're just hunting for that ultimate AI infrastructure play, you absolutely need to see this fundamental breakdown. Right now, practically everyone on Wall Street is screaming that ePlus is a flawless AI rocket ship. And, on the surface, it sure looks like it. But what if I told you their explosive top-line growth is actually hiding a massive, glaring working capital trap right there on the balance sheet? It's exactly the kind of trap that routinely crushes retail investors who only look at headline revenue. Seriously. Last week, I took ePlus's incredibly complex fiscal 2026 results and ran them through 5 rigorous valuation models. Then I checked those numbers against the legendary investing checklists of Warren Buffett and Peter Lynch. And honestly, what I found lurking just beneath the surface completely shocked me. By the end of this explainer, you'll know exactly if ePlus is a classic Buffett-style buy-the-dip compounder or a dangerous Lynch value trap. Plus, I'm going to give you a clear, actionable framework you can just steal for your own stock analysis. Let's dive right in.
Okay, let's start by unpacking this crazy contrast, because right now we're looking at a classic clash between absolute top-line AI success and some really sneaky hidden execution risks. The headline numbers for ePlus, they're nothing short of massive. We are talking about a record $3.8 billion in gross billings for the year. That's a 17% jump. Net sales? Up over 22% to hit $2.4 billion. I mean, on paper, it looks like a total blowout, right? But here's the thing. It's kind of like an iceberg. The most dangerous part of this company's financial health is completely underwater. We're going to explore exactly how they generated this absolute mountain of cash, and maybe more importantly, why a terrifying amount of it is currently getting locked up and trapped. $4.71. That right there is ePlus's diluted earnings per share for the full fiscal year. Let that sink in for a second, because it represents a staggering 64.2% surge compared to last year. If there was any lingering fear out there in the market about a hardware digestion period, that phase where companies just stop buying new tech gear to process what they already have, well, this number officially puts a nail in that coffin. Their operating leverage is literally firing on all cylinders right now, and ePlus is just absolutely capitalizing on this renewed wave of enterprise spending.
And you can really see that momentum when you just look at the raw revenue scale. ePlus vaulted from $2 billion in fiscal 2025 straight up to $2.44 billion in 2026. That 22% leap was primarily driven by just explosive growth in product sales, especially during the fourth quarter. It tells us that enterprise customers aren't just out there buying routine replacement parts anymore. No, they are aggressively building out heavy-duty AI-ready infrastructure. They desperately need that raw processing horsepower, and ePlus, well, they're the ones happily supplying the picks and shovels for this gold rush.
But you gotta ask, how did they position themselves to capture all this demand in the first place? Well, management actually executed a series of pretty ruthless strategic moves to totally transform the company. Back in August 2024, they scooped up bailiwick to rapidly scale out their professional services. Then, in June 2025, they made a massive pivot. They completely divested their domestic financing business, cut the fat basically, which allowed them to focus entirely on being a pure-play IT solutions provider. And it paid off. By March 2026, those calculated moves culminated in that record $3.8 billion in billings we just talked about.
So where exactly is all that enterprise capital flowing? When you break down the fiscal 26 billings, the shift is incredibly clear. Over $1.15 billion poured straight into networking, and just over $1 billion went into cloud. Security is also taking up a massive chunk at $841 million. Now, why those 3 specifically? Well, think about it. If you're a Fortune 500 company, you literally cannot deploy artificial intelligence without those 3 foundational pillars. Customers are prioritizing them because, frankly, they have to.
And this brilliantly illustrates an absolutely crucial competitive moat for ePlus. Their COO, Darren Regal, actually pointed out that they engage customers really early in their AI journey to help them develop actual practical use cases. It's brilliant when you think about it. When ePlus goes in as the high-level consultant to help a business map out its AI strategy, it almost inevitably leads to that same business buying all the heavy hardware from ePlus down the line. It's a classic land and expand strategy, and it's working to absolute perfection, pulling through massive infrastructure sales.
So the crucial point is, with all this explosive top-line growth and seemingly perfect execution, what exactly is hiding on the balance sheet? We've covered the bull case, right? The AI pull-through, the record billings, the massive earnings per share. It sounds great. But to be a really smart investor, you have to flip the coin. There's a specific set of data points in this exact earnings report that entirely contradicts that pristine execution narrative, and it revolves completely around cash flow efficiency.
Let's look at the fourth quarter. Year-over-year revenue grew a very healthy 20.6%. Awesome. But beneath that, inventory absolutely surged by an alarming 66.8% to nearly $201 million. And accounts receivable, the money customers owe them, that spiked over 31% to almost $668 million. Look, when your inventory and your unpaid bills are growing literally 3 times faster than your actual revenue, it's a massive red flag. Management blamed this on projects in process, which, translated into plain English, means a ton of cash is currently trapped in unfinished jobs and delayed collections. To really grasp the real-world danger here, we have to look at the cash conversion cycle. This is a metric legendary investors like Warren Buffett watch like an absolute hawk. It's simply the number of days it takes a company to convert its investments in inventory back into actual spendable cash from sales. For ePlus, this cycle jumped by 10 whole days sequentially, landing at 51 days. Compared to just 29 days a year ago, that is a massive deterioration. Bottom line, they're buying the gear, but it's taking way longer to get it deployed, billed, and actually paid for. And this execution bottleneck, it bleeds right into their profitability. Product margins are actually getting squeezed, dropping down to 22.2% in Q4. Why? Because they're selling more traditional, lower-margin hardware to win these highly competitive enterprise deals. However, their saving grace right now is absolutely their services side. Professional services gross margins expanded beautifully to 38.3%. So this high-margin service mix is essentially acting as a critical shield, protecting their overall bottom line while their hardware margins take a pretty serious beating.
Now, what's really interesting and a bit scary is that despite those great service margins, the actual revenue growth behind them has essentially flatlined. In Q4, professional services posted a surprisingly meager 1.6% year-over-year increase, coming in at $61.3 million. Management pointed to project timing delays, particularly with retail customers, as the culprit. But no matter how you slice it, it's a severe deceleration. Remember that early AI consulting we were just talking about? If that organic service demand starts drying up, it directly threatens the tip of the spear for all their future hardware sales. Which brings us to how ePlus actually views the next 12 months. And spoiler alert, they are pumping the brakes hard. During the earnings call, management explicitly caveated their upcoming guidance. They flat out stated it does not factor in recessionary conditions or other unexpected developments. They also flagged potential headwinds from a looming worldwide memory chip shortage and ongoing geopolitical uncertainty. They are clearly, deliberately baking a heavy layer of macroeconomic fear right into their immediate outlook. And boy, does that caution show up in the numbers. For fiscal 2027, they're forecasting highly conservative mid-single-digit growth across the board. It's a sudden, jarring deceleration from the 20+% growth we just saw. Yet, despite all that, they are operating from an absolute fortress of a balance sheet. I mean, they ended the year with $411 million in pure cash. That immense financial flexibility is what allowed them to confidently raise their dividend by 8% and repurchase 90,000 shares. So even as growth slows down, they're still aggressively rewarding the shareholders who stick around. Which leaves us with our final verdict, the million-dollar question. Is ePlus perfectly positioned to ride this AI wave, using that early consulting strategy to drive massive hardware sales for years to come? Or will the sheer weight of trapped working capital and a lengthening cash conversion cycle ultimately drag them down? The framework here is crystal clear. If management can untrap that cash and speed up those deployments, this stock is a compounder. But if that inventory just keeps stacking up, it's a textbook value trap. Dig into that balance sheet, weigh the facts, and decide which side of the equation you believe in. Thanks for hanging out with me for this explainer, and keep learning.